We just have to go through the disclosure. Yeah, I like that. That'll work. All right, let's do this. You ready, Todd?
Yeah, let's do it.
All right, guys, welcome. We're going to get started here. Thanks for being here and on time. We're going to go through our typical disclosures before we get started. Hope you guys can all see this. At Green Chart, we are a charting software and education company. Foreign exchange, futures, or any trading option is highly risky, and you can lose all your money if you invest in your own account. We are not responsible for your investment, trading, or tax decisions. We're not licensed financial advisors, traders, accountants, stockbrokers, attorneys, or commodity brokers. We're not an introducing broker. As you apply what you learn, we recommend you seek advice from licensed professionals. All materials including this production, are considered opinions and not trade advice. So we're going to be talking a lot about our personal opinions. And that's not something you should just hourly go out and trade without doing some of your own research. We sell trading charts and education. We make no promises that our charts or education will generate future income to our clients. And you may not make your investment back. Please note that any trade results that we show should not be considered typical of our clients. And I might create something later, Todd, where we just put this on like a slide, and I think we can go through it. I don't think we actually have to read it. But there we go. So welcome, guys. Welcome to our first Traders Pulse, brought to you by Green Chart. I'm one of the moderators and hosts, Matthew Pohl. I've got with me Todd Tolman, our CEO. And I would say, I don't know about Todd, but I'm excited. How you feeling tonight, Todd?
Good. Very excited.
Awesome.
This is something we've been talking about for a while.
Yeah. So, both of us are pretty excited about this. There's been a lot that's been going on this week. But before we jump into like our topics and like what we're doing tonight, I thought it would be good to kind of set this up. So this is not so much a Q&A. We might open it up at the end just to play with it today. Like, let's just see how it goes. We'll allow some Q&A at the end. So if you have a question about something we're going over, just type it in the chat. We're not going to get to it immediately, but I think we'll come back to it at the end. Whether or not that makes our actual podcast, we'll decide on later. We do this Wednesdays and Fridays going forward, and this will be a free public service that we do going forward to help market Green Chart and really show you our stuff, really show you things that if you're a trader or any type of investment advisor, etc., this is an easy place that can be your go-to to get updates without all the noise, without having to go to the news, without all that fear mongering. And you can kind of just shortcut all that. Get to us. Wednesday's going to be a midweek report. Friday's going to be a full week report. And you'll just have to check in once a week. Twice if you're really ambitious. You can come to our Wednesdays. Anything you would add to that, Todd?
No. Did you mention that as a member, you get to see the streaming live version of this podcast? But if you're not a member, you have to wait for it to be posted on YouTube.
Yeah, so we're doing this. Yeah, great point. So we're doing this live to our Green Chart members, but for anyone else, we're actually not doing that. So they'll see it delayed by a couple days. Friday, they might see it. If we're ambitious, it might be the next day. It might be a little sooner, but it won't be live. And so if there's something hot going on, you want to be here live. But I don't think you'll miss out much on this market stuff. This is mostly going to be a fundamental. We will do some technical analysis sometimes, but this will be a fundamental overview of what's going on in the market week to week. So let me give you our 3 topics, and then we're just going to jump right into this. And just so you guys know, I have my own opinions. Todd has his own opinions. We might butt heads at times. That's okay. The point of this is we're coming in with our own ideas, our own research. We'll battle it out, and then it's up to you to decide, right? But the 3 things we're going to talk about today are big topics, I would say, and they've been talked about and been on the news all week. The first one we're going to go over is interest rates and inflation. I don't say or versus, because it's really, they kind of are happening together. The second thing we're going to talk about is bank failures. And like, is this thing over? Like, are we in the clear, or is there cloud cover ahead? And then the last thing that we're hearing a lot about is from the CBDC, and that's the dollar reserve currency. This thing that we're talking about, this digital dollar reserve currency. Also, is the dollar going to be it? Is the dollar going to be the thing that we're pegged to? So we're going to talk about those three topics. Did I miss anything there?
No, that's good.
So let's just jump right in. Todd, why don't you launch us? What you got on the first thing? What's
You're letting me lead
what's
on
in
this,
your
huh?
world? Yeah, what's in your world and in your head on this whole interest rates and inflation thing going on? I'm
You
curious.
want to talk about interest rates and inflation? All right.
Yeah. You got something?
Yeah, I can do something there.
And when you do share screen, you can typically pick it, just the image, and it'll blow it up really nice.
Okay, this probably isn't exactly how we want to approach this, but
That's okay. So what you
yeah,
got
so
there?
can you see that image? Okay, I can't see what you see.
Yeah, what I would do, hit stop share screen. And then when you hit share screen, pick that image. It should be up on your desktop. That'll make it real big for everybody.
All right.
Oh, there you go. Perfect. Love
That better? Hopefully everybody can see. Pipe in if you can't see that. I can make it bigger.
No, it's great. It's huge.
Yeah. So if we're going to talk about interest rates, and we're going to talk about inflation, we really need to talk about what's happening globally with the dollar first. And you're going to probably have to put the brakes on this one, Matt, because I could wax quite a while on this topic.
Yeah, tell us what we're looking at here. I've never seen this chart before.
So yeah, the International Monetary Fund website. You can get all kinds of charts of the week, and this is one that I grabbed. I don't think it's for this week, but it was fairly recently. So this is the currency composition of foreign banks and their reserves. And so one thing you need to understand is that the world uses the US dollar as their reserve currency. You may or may not know the history of that, but before when we were in the middle of World War II, we were living on the gold standard, which meant that all currencies worldwide were backed by gold. And the US was late to the war. World War II had already been going on a while before the US got involved. But during that time, everybody bought from the US for their guns and ammo and their tanks and all the war machine materials that were needed by our allies, and they paid us with gold. Okay, so fast forward about 1944, about 44 allied nations got together at Bretton Woods, New Hampshire, and had a meeting to decide how the banking industry was going to work after the war ended. And so, as you know, in September of 1945, World War II ended. But one thing they decided during that meeting was that because the US had accumulated almost 80% of the world's gold, that nobody, everybody wanted to go back to the gold standard, but nobody had any gold except the US. So what they decided was, and I'm sure, Matt, I'm sure our politicians and the bankers in the US had a lot to do with this, but it was decided that instead of putting gold as their reserves in their vaults worldwide, they would put dollars.
Right.
And so the US dollar became the reserve currency of the world. And everybody just kept dollars. And at the same time, the deal was this: if you don't want your dollars anymore, send them back. And so a bank could literally send back their currency or their reserves back to the Federal Reserve Bank of the United States. and they would ship the gold back to them. So that was the deal. And honestly, the dollar was pegged to gold was pegged to the dollar. So there was no free floating gold price at all. It was fixed. It's like $35 to the ounce or something like that. And that's how the world worked. But you know, when you're in control of the world's reserve currency and you need money, what's the easiest way to get money? Print it, right? And so, as foreign countries bought treasuries and bonds, anything denominated in dollars in order to store their dollars, they started to unwind and send their dollars back to the U.S. And so over a period of about 25 years, and remember, during that time, we had to fund the Vietnam War, and we also had the Great Society from Lyndon Johnson, and all these programs that the government rolled out. We needed to borrow. We needed extra money for that, and so the world saw that we were watering down the currency. And so the dollar started coming back and everybody started buying gold again. And so we kind of blew it. But as a nation, in 1971, I think it was like November 14th, 1971, Richard Nixon got on public television. You can still watch the news clip if you look it up on YouTube. And he basically said, we are closing the gold window. We are no longer allowing you to take gold in exchange for dollars. So effectively, it was never put this way, but effectively, we were filing bankruptcy as a country at that point, in my opinion, right?
So what are we looking at?
So what you're looking at here is the decline of U.S. reserves. So if you go back to 1999, it was over 70% of the world held 70% of the banks held the dollar as a reserve currency. But fast forward to 2021, it's down to 59%. And you can see that the red line moving up is other currencies, such as the renminbi, it's the Chinese renminbi, the Swiss franc, Canadian dollar, Australian dollar, all those combined are starting to overtake the US at this point. Even the euro is sinking.
So there's a lot of talk about this, and I've got an interesting clip that I'm going to save for later, but are you saying, or is it your opinion that you think this chart is just going to go on a cliff for the USD?
No, I don't know if it's going to be a cliff, but listen, there's a lot more that's going on because the world no longer wants to hold dollars. They're going to have to hold something. And there's a whole other discussion about the BRIC nations who are getting together and they're accumulating lots and lots of gold. And you sent me an email the other day showing the banks and how much they're accumulating gold.
Right. And more than ever before.
More than ever before. And it's been hush hush.
Like 2x in the last year than the previous years. So they are very much hiding. Yeah, that's an interesting phenomenon.
Yeah.
So I'm curious what your position is, because there's a lot of people who are saying, well, this is the end of the dollar, like start stacking, if you listen to like the crypto guys, they're like, move into crypto now, like your dollars aren't safe. It looks like we've got a lot of time. I mean, based on this chart, this is 20 plus years that we had less than a 10%, maybe a 10% decline. Clearly we have time. And I would also add to your comments, China, I don't know how many people know this, but everyone's like, oh, China's taking over. It's going to be the yuan. Well, the yuan's pegged to the dollar. So that'd be impossible to happen anytime soon. They'd have to unpeg. They'd have to come off of that. Well, and there's no sustainability yet in that.
Oh, it's going to happen. It's going to happen.
You think so?
Yeah. Well, listen, there's other things we can talk about here as far as the dollar being desperate.
So what do you think? A year, 5 years, 10 years? Like how long? What's your guess?
Well, I don't know. I mean, here's the deal. Have you heard of FedNow?
Yeah.
Okay.
Yep. Go FedNow.
No, it's just FedNow. Let me throw up something
Oh,
else
is it?
for you to look at.
You're talking about the CBDC thing, the thing that launches in June, right? It's
It
basically
actually launches in July.
oh,
So this is why I think the Fed is desperate. So because of all the cryptocurrencies, because of what's going on there, PayPal, all the alternative ways of making payments, which have emerged over the last 20 years, has really hurt the Fed. And they've lost a lot of power because of that. And for a variety, I mean, if you control how people transact, then that gives you a lot of power. But because of all these new technologies that have sprung up to allow people to transact without going through directly through the bank, they've lost a lot of control. Well, FedNow was announced in 2017, and now they're finally there. A lot of people think this is the first step to a Federal Reserve cryptocurrency.
hmm,
But really, all it is, if you read up on this, it basically says that you will be able to conduct instant transactions,
right,
instant settlements
right.
from your checking account to somebody else's checking account.
It replaces the wire system we have now, the
Yep.
SWIFT system,
I mean, the last innovation in the banking industry
which
was
was
in
way slow,
1971.
right? Right, it's super slow,
Well, ACH was the last innovation that the Fed had in
right?
1971. So they're just trying to catch up.
Do you imagine the
That's
banking fees will drop with this new technology, or do you think they'll kind of keep their fees the same?
Well, I think the fees will drop, but their control over the public is going to increase.
Yeah, for sure. And transparency will
And
increase. All right. We gotta move, keep moving. Any last high level
not on that.
thoughts on this? I want to share this real quick, Todd, just in correlation with what you've been talking about. I found this debt to GDP chart. And I think this is really relevant when we're talking about inflation. And a lot of people, if you're new to trading or new to the markets, you may not understand what either of these things are. But, debt's obviously how much debt we have. GDP is gross domestic product. And that's like how much we produce. It's like at the end of the day, you have all the laborers, you have employment, you have all this stuff. And it's like, well, how much does that actually produce? And you can see that production, GDP versus debt, the ratio, the gap. I mean, you see this, Todd? It's like uncanny. And like the last, 2022, look at how steep
It's a
that
hockey
climb.
stick.
Yeah, and it's like the GDP did not. It is interesting though. I did notice. Look how flat it's gone through these weird new trends. And in the last since 2019 to current, GDP is like on this new trend. Is it keeping up with the trend of debt? Absolutely not. We've got a big gap to close. And I think this is the important thing that I saw around this that I wanted to bring up. Why the feds are targeting employment so hard. And it's because GDP is a byproduct of employment. Like the more people you have employed, the more workers you have out there working, the more production you can get. And so the smaller the percentage is, the more output you can get. And so in order to tackle inflation, in order to get inflation down, we have to attack GDP. We have to attack producers to start bringing the price down. I saw a ton of charts on this, but when a lot of people are like, oh, the Fed, you see on the news all the time, the Feds are, causing unemployment. Yes, like they're doing that on purpose. And the reason is they won't fix this chart. But the reason is if you looked at a chart with GDP and inflation, is they're trying to get the correlation to come back because they actually work together. So anyways, what are your thoughts on this chart?
Yeah, well, I mean, this is interesting because they're interrelated, which is interesting. Because the government creates more debt so they can go spend. So they sell treasuries to the banks, to the Federal Reserve. They sell treasuries to the general public, and then international banks pick up a lot of treasuries. So that the federal government, our federal government, does that so they can get the money to spend.
Right.
And I don't have a deficit chart to show you, but we actually there was the numbers that came out today on the deficit. I can show that here in a minute, but basically, you can generate more GDP if the government spends more.
Right.
But in order for the government to spend more, they have to spend more than they get in revenue. So that's called deficit spending. When the government deficit spends, it creates more inflation. So when you have more inflation, then your dollar doesn't go as far and it stagnates the economy. So what we got now is a stagnating economy with high inflation
and growing debt.
It's called stagflation.
Right.
And it's so you can't, so that there's a twofold, the goal of the Federal Reserve is twofold: to maximize employment or minimize unemployment, right? That's their first call that they've been asked to do. And the second one is to control pricing, to control inflation. You need a stable dollar in order for businesses to be able to plan for the future. If the dollar is losing value at an accelerated pace, how is it possible for you and me as business owners to predict what's going to happen in the future?
Yeah, you can.
And so what that does is it stagnates business. Less businesses start up, and there's less employment now.
Right. And we have this is why we have supply chain issues. This is why we have.
Well, COVID started that in a big way, but it was already happening before COVID.
So check this chart out. Have you heard of the Phillips curve before?
Yeah, I have.
Yeah. So this is economics 101. This is why the Feds attack employment, is because the Phillips curve, even though people will argue it doesn't follow exactly, it's like, yeah, but there are like three factors. It all funnels into this GDP thing, this chart we were showing you before. But it's just really simple. Like right now, we're at B. In fact, we're like better than B. We're at like 5% inflation, 6% inflation, and our employment rate is well below 3%, right? I don't know actually where it is right now. I have to look that up. But like Utah, it's like super low. It's like there's no one unemployed here. But the way we fix inflation, if you want to get it back down to 2%, which is going to save the economy, it's going to save your retirements, it might, help push the Social Security problem later down the road. We got to get unemployment up to 6%. And when people hear that, they go, oh, that's millions of jobs. That's hundreds of thousands of layoffs. That's, tears and ag. It's like, yes, it is. And it's also what's necessary to save the country. It's what's necessary to save the current currency reserve system. And the banking systems fail if we don't do this. Businesses fail, like Todd said. And so that's why they're attacking unemployment. And that's why we likely will see at some point, guys, 5 to 6 unemployment rates. And so for me, what's the takeaway? The takeaway is your job's not safe. The takeaway is your neighbor's job isn't safe. The takeaway is whatever impacts jobs will impact other markets like real estate and, certain supply factors. So like things that are putting a lot of demand on a certain market, you have less people who can buy because they don't have jobs. Guess what happens? Less demand. Less demand, prices start to jump down. That fixes inflation. And so this is really why the Phillips curve is something that we talk about a lot when it comes to inflation. And this is really why this is one of the small factors that you'll see the Feds or the Federal Reserve take into account when they're like calculating, should we increase interest rates or not? And so my prediction is you'll see another interest rate increase, even with the bank failings, even with like the stuff that's happened. A lot of people are saying, oh no, we're not going to see another rate increase. They would never do that. I don't think we have the numbers yet for the Feds to take off their foot on the pedal. They still have to kind of keep it down, to kind of tip it over the edge. And then once we start seeing unemployment rates come up, then they'll start to ease off and you'll see interest rates start to go flat. Any last comments, Todd? We got to move on to the next topic.
No, I think you nailed it. I mean, this is very simplified, but it's a good model to understand how it works.
Agreed. Since I've got the mic, I'm going to move on to the second thing. Let's talk about bank failures. I actually have a really fun thing I want to try on here. See if I can get it to work. I've got a quote. So Warren Buffett was actually interviewed. He was interviewed on CNBC, I believe it was. Let me see if I've got that here. Yep. He was interviewed on CNBC, and this is only 3 minutes long. I've taken 2 clips from the interview, and I want you guys to see this. I mean, he really nails it, and he brings up 2 points that I think are valuable to talk about. So let me see if I can get this shared. Reason. Here we go. Share sound. All right, here we go.
United States about something they don't need to be.
We through the banking crisis at this point. We through the banking crisis at this point.
Well, we're not through with bank failures, but we are through the depositor. The depositors haven't had a crisis. The owners of banks may have lost a hell of a lot of money. The people who bought the debt of the holding company, they may lose a lot of money. People can lose a lot of money, but the depositors aren't. And so you don't need to turn a dumb decision by managers into a panicking the whole citizenry of the United States about something they don't need to be panicked about.
We have had lots of investors in commercial real estate who have come in and said that this is going to be a crisis point, that the government is going to have to step in, that something should be done because there are so many commercial real estate loans that are coming due between now and 2025, and that they won't be able to get credit from the banks in the same way to renew or to, once those maturities come due, to refinance.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago, or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but
I'm going to end it on that. Todd, is this your first time seeing that?
Yeah, it is.
I'm curious what your just initial thoughts are. Right? There's 2 bullet points, right? The first was depositors are safe. Like, there's a lot of talk about depositors. Right. The second was the commercial banking crisis or problem that's coming up.
Well, we no longer live in a laissez-faire economy when you can, I think I heard the statement, just about a week ago, it's not a good idea to privatize the profits of a business, but socialize the losses. And the problem is this is called moral hazard in banking and in business. When the government bails out some people, but not others, or bails out banks in general, what does that do to the bank's future actions? Well, if they know that they're going to get bailed out the next time they come around a hard corner, then really they just factor that into their risk model and they don't care. It makes them even more risky.
Yeah, you're saying that it promotes recklessness or promotes loose.
It's moral hazard.
Yeah, moral hazard. Yeah, that's a good way to say it. What are your thoughts on the there's been a lot of talk over the last week about depositors, and a lot of people who have money in banks have been doing small runs on the bank. In fact, we've seen some bank failures because people have been afraid that their money in the bank is actually at risk. Warren Buffett said, no, depositors are fine.
Yeah, well, I think bank runs are good. I think bank runs are healthy. And I think bank failures are healthy because what it does is if a bank fails, then somebody's going to come in and pick up that dying bank that's a little more smart than the bank that failed. and they're going to make it better, and they're going to make sure that that doesn't happen again. And if the public, I mean, in this information age, there's so much information. If the public is wise, they'll wise up to the fact that this bank is now owned by a smarter management team, and I might want to put my money in there now. But if a bank keeps getting bailed out, I mean, it's just a race to the bottom.
Yeah, it really sets a precedent, doesn't it? It sets this tone that, oh, if that person can fail, so can I. So I better button things up. What are your thoughts on the second part, though, this commercial lending crisis?
Well, I mean, yeah, it's a commercial lending crisis because the rates are high.
Right. Say more about that. Like, how does that work?
We got huge inflation, but nobody's willing to borrow right now. I think that's what we're going at here, is because rates are too high, and people are already.
So why do you think it creates a crisis? Like, why are the banks going to have? I mean, I've seen articles that's like in 2 to 3 years, there's going to be this massive banking crisis around commercial real estate. Why did rates cause that? What do you think happened?
Well, that's a really good question, and it's all comes down to reserve requirements. So when you tighten up, when the Federal Reserve decides to tighten up money, they raise the interest rates. That means that if a bank wants to borrow money from the Fed, they have to pay a higher interest rate, and then they've got to pass that on to you and me, the business owner. And so what it means is because I can't afford, I have less people wanting to do loans because the rates are so high. I have less money in my bank for reserves.
Right.
And as you know, a bank can only lend out based on how much reserves it has.
Right.
And right now, the law is that a bank can lend up to 10 times its reserve requirement. Right. So if it has $10 million in reserves, it can
add a zero. That's right.
Add a zero. It can loan out 100 million.
Right.
So as those reserves are shrinking, then that puts a crunch on commercial lending.
Yeah, I'll tell you one of the things I am looking at, because I own a bunch of commercial real estate across the country. Do I have anything out of the country commercial? I don't. But the problem with commercial real estate is also the term, where most people don't realize, because their home is in more likely than not a 30-year mortgage. Some people do 20, a few people do 15 years. Commercial is usually 3 to 5. They're ARM loans, essentially.
Yeah.
It's like, oh, we'll do it for 20 years, but we're going to have to adjust the rate, just like the banking crisis we had in 2008 for homes, right? We're doing all these adjustable rate mortgages, but for houses, same problem. When I have to refi my loan with the bank, I have a lot of them coming up in the next year or two. I have to look at my books and go, am I going to have enough rent to cover my new mortgage? And we're already seeing, like in LA, I heard BlackRock actually last week had, they just defaulted. They just said, no, we can't pay this. And they gave the building back to the bank. I think if there's a banking crisis to be had, I don't think it's going to be with homes. Do I think there's going to be some correction there? Absolutely. Do I think some people will be impacted, lose their homes? Yes, nothing like 2008. But I think the commercial world is going to get hit really hard. And guys, the thing you're going to hear from Todd and I is when there's blood in the streets, so to speak, when there's beat up markets, there's also massive opportunity, massive. And so again, not giving trade advice, but there are going to be huge opportunities to get into commercial real estate, whether it's physically, whether you buy into a fund, an ETF, some type of, you hook into BlackRock, but maybe at a better time. Obviously this doesn't look like a great time to get in on BlackRock, but I think the potential for, moonshots, so to speak, in the real estate market, it's coming, but you got to let the dust settle, right? And the dust is we're just seeing things fall, and the dust is starting to come up.
Yeah.
Great. Do you have anything else? Do you have any things you'd like to bring up on that?
No, I just think it's the old adage, if cash is king, get out of debt and have cash on hand. So when everything unwinds, you can buy back in. And there's a lot more to go about on that. But all the people that are pulling the strings at the top have their cash ready. So when this thing tumbles, they're going to buy.
Right.
But we're at the bottom of the hour, Matt.
Yeah, great.
I
think that's great. That's a great way to wrap up, guys. And thank you, Todd, for your feedback. Today's going to be short. We keep this we try to keep this close to 30 minutes, unless there's a hot topic that we absolutely have to drive to you, our audience. Friday, we're going to do a full hour. So we'll recap on some of these topics. We'll have some more things that obviously are going to happen between now and then. Some Fed minutes actually came in today. We didn't have time to go over that. We'll go over that probably on Friday. There's a bunch of announcements also on some of the future banks and bank failures. Let me give you guys a teaser for Friday. How about that? Can I do that, Todd, real quick?
Yeah.
I have a fun chart that I think when people are talking trading, this might help some decisions. I just found this. It was just published today. I just saw this chart today. And it speaks for itself. I don't think you have to really go through this more than what's on here. But this came from Bloomberg. And this was a Canadian, a release from Canada. And these are the largest short bets on financial stocks globally. Canadian lenders' top list of biggest bearish bets. And you can see, obviously, the Toronto Dominion Bank, which is a Canadian bank, has the most. For Canadians, that makes a lot of sense. But look even how in Canada, Bank of America, JP Morgan Chase, Citigroup, UniCredit, Blackstone, and these are 1, 2, 3, 4 in the billions short positions. So people who are smart, people who understand the markets, understand the future, there are some massive short bets on banks right now, and they're not in the millions, they are in the billions. So are there people out there thinking there's going to be some opportunity, making money, having the banks go down? I think the chart speaks for itself. I have my own opinions on this. I'm sure you do as well, Todd, but I think we could end on that. What do you think?
Yeah, that's great.
All right, so wrapping things up, I don't see any chats or questions in the chat box, so we'll close this out. Feel free to join us, guys, on Friday. Friday will be a full hour recap of what's happening on the markets, both on a micro and macroeconomic level. And yeah, thanks for joining us tonight on the Trader's Pulse.
Thanks, everyone.
Have a great night.
Thank you.